Right now might be a special chance to make lots of cash. When things aren't going great, that's sometimes when folks hit the jackpot. If you play it smart, you could set yourself up for life with some awesome deals and opportunities. Let's break it down. You know how they say bad times can mean good money for folks who invest? Well, that's what some successful folks like Warren Buffett reckon too. But what's the deal for the next year or two? How do you take advantage of it now? And what moves can make you richer? Let's dive in. First off, what's a recession? It's when the economy isn't doing well. People lose jobs or earn less money. Everyone spends less, feeling less sure about things. Prices drop for stuff like stocks, food, and services. And this can shake up the whole world for quite a while. Next, when a recession hits, businesses also rake in less cash. Every 3 months, businesses tell us how much money they made and what they expect to happen next. But lately, they have been saying that they will make less money or lose money. They say that the economy is not doing well and there is a chance of a recession. This is the worst it has been in 10 years. This leads us to the third thing, people losing their jobs. When people have less money, they buy less things. When businesses sell less things, they try to save money by cutting costs. The first thing they usually do is fire some of their workers. If you search online for mass layoffs, you will see many businesses that are doing this. And Bank of America says that the US economy will start losing 175,000 jobs every month soon. So what does this mean for you and your money? And how can you use this information to make more money? Let's begin with the first thing, stocks. The 3 major stock markets in the world, the Dow Jones, the S&P 500, and the Nasdaq, are all down by more than 20% from their 52-week highs as of November 23, 2023. This means that many stocks are trading at a discount, and you can get them for a bargain price. But how do we know when the market will bottom out and start to recover? Well, no one can predict the future, but we can learn from the past. According to historical data, the average bear market, which is a period when the market declines by 20% or more, has lasted 14 months and resulted in a 30% loss since World War II. The worst one was in 2007 to 2009, when the S&P 500 fell 57% from its all-time high. However, the good news is that every bear market has been followed by a bull market, which is a period when the market rises by 20% or more. The average bull market has lasted 65 months and resulted in a 267% gain since World War II. The best one was in 2009 to 2020, when the S&P 500 rose 400% from its lowest point. Now, you might be wondering, what if the market crash is accompanied by a recession? Well, that is a valid concern because recessions tend to make the market crash even worse. The average bear market during a recession has lasted 18 months and resulted in a 37% loss since World War II. However, there have been some exceptions, such as the 2001 recession, when the S&P 500 fell 49%, and the 2020 recession, when it fell 34%. That means that the lowest point is usually when most investors give up and sell their stocks. That is also when things start to get better and stocks go up again. The important thing to remember is that recessions are also temporary, and they usually end when the government and the central bank take measures to stimulate the economy, such as cutting interest rates, increasing spending, and printing money. These actions can also boost the stock market, as they make borrowing cheaper, increase demand, and create inflation. So, what does this all mean for you as an investor? It means that you should not panic or sell your stocks when the market crashes, but rather take advantage of the opportunity to buy more at a lower price and wait for the recovery. The key is to have a long-term perspective, diversify your portfolio, and invest in quality companies that can withstand the downturn and grow in the future. The second thing is real estate. Real estate prices are different in different places. Some places might still do well, but it is very rare for the whole country to have lower prices. As you can see, in the last 60 years, there were only a few times when prices went down a lot, more than 10%. But now, many experts think that the average price in the country will go down 7%. If the interest rates go up more, the worst case is that the prices will go down 10% to 15%. Of course, some places will be worse than others. According to Moody's Analytics, The places that are most at risk could see prices go down 25% from the highest point. These places include parts of Florida, Arizona, Idaho, and Southern California. The prices might keep going down for another year or two before they stop. The third thing is cash. Until now, many people thought that cash is losing value because of inflation. But when everything else is losing value too, sometimes cash is the best place to keep your money safe. Even the rich guy, Ray Dalio, said that cash is not bad anymore. The truth is, many people don't remember that in 2018, cash was the best thing to have. If you just saved your money in a bank account that pays you interest, you would have made more money than anything else. Now, cash is very important for many people. Even the people who manage big funds are keeping a lot of cash since 2001. And Citigroup said that cash is the only thing that can protect you from a recession. But how can you use cash to make money? And why do many people miss this chance? Let me tell you. The first reason why this recession could be a great chance for you is that everything becomes cheaper. I think that even though some people might think this is a bad time to buy things because everything is going down 30%, rich people would think this is a good time to buy things because everything is 30% off. Warren Buffett said it very well. He said, when burgers become cheaper, we are happy. When burgers become more expensive, we are sad. For most people, this is true for everything they buy, except for stocks. When stocks become cheaper and you can buy more of them, people don't want them anymore. So first, change your mind, because a low market can help you. The second thing is that there are fewer people to compete with. The truth is, when things are hard, businesses cut costs, close down, save money, and don't take risks. But this gives a chance for smaller, more brave businesses to take their place and grow. For example, one study of 16,000 businesses found that those who kept advertising made more money and got more value with good growth. The market cycle is like a forest. When the market is at its highest point, only the big and strong companies can get all the resources they need, like sunlight. The small and weak companies have a hard time growing and competing, but sometimes the market goes down and many companies fail. This is like a forest fire that clears out the old trees. This is also a chance for new and small businesses to grow and develop. This happens again and again in our economy. A smart investor said this a few months ago. The market cycle goes up and down. When the market is low, many companies lose money. This is called a bear market. Yahoo Finance says that the S&P 500, a group of big companies, has lost about 29% of its value on average when this happens. But the market does not stay low forever. It goes up again. This is called a bull market. Yahoo Finance also says that when the market starts to go up, the S&P 500 gains about 40% in 1 year and 58% in 2 years. This means that buying stocks when the market is low is better than selling them and waiting. The market has always gone up again in the long run, no matter how low it was before. The last thing you need to know is that you have to act fast. You can't wait for the news to tell you that there is a recession. The news is always late. For example, the big recession that started in 2007 was not announced until 2008. And the recession before that started in 2001, but was not called a recession until later that year. This happens every time. We only know we are in a recession after 6 to 12 months. But you can do some things to make money from this. One thing is to spend less money. You need to keep track of your money and only buy what you need. You also need to invest more money in the market when it is low. Another thing is to have a plan for what you would do if you lose some of your income. Maybe you can find another way to make money or save more money. You should do this before it happens, so you are ready. Step 3. Safeguard your job. Ultimately, this will be your top defense no matter what occurs. Financially, the worst situation isn't just the market dropping, but it's when the market falls while you lose your job and have to sell your investments when they're at their lowest before they bounce back. Right now is the prime moment to enhance your skills, learn new things, and focus more on what you're already doing. After that, keep at it. In the end, your best defense against whatever comes your way is safeguarding yourself, because your biggest worry isn't just the market dropping. It's when the market dives, while you also lose your job and are forced to sell your investments at their lowest point before they bounce back. Right now is the perfect time to improve yourself, learn new things, and focus more on what you're already doing. After that, step 4 is about investing for the long haul. The smart move in investing is to keep going as you normally would and act like nothing's changing. Studies have shown that regularly investing, known as dollar cost averaging, is the most profitable strategy. So stick with the market and keep investing regularly. Step 5 is diversifying your investments. If a 20% drop makes you super nervous, it might mean you're taking on too much risk with your investments. For example, if all your money's in US tech stocks, it's smart to mix it up by adding big company stocks and investments from other countries. You could even think about real estate or getting into renting stuff out. They tend to be steadier. The more variety in your investments, the better. If one or two parts take a hit, your whole savings won't crash. Overall, it's a good idea to also focus on doubling down on your work. Maybe pick up a side gig and soak up all the knowledge you can. What you do now is going to pay off big time once the market bounces back. It won't be a walk in the park, but trust me, it's worth it for those who hang in there. Thanks for tuning in. Subscribe for more weekly investment tips. Drop a comment below.